everyone for joining us today. Sorry for the technical difficulties, but we are here now and we're excited for this webinar. My name is Colton Pond. I'm the marketing coordinator here at Health Equity, and I'm excited. I'm just going to give you a brief introduction of the webinar today that we'll have presented by Danny Humphrey. And then what we will do is I'll turn the time over to Danny, and he will give the presentation about the enhancements upcoming to the Health Equity Investment Platform. A couple of housekeeping items. First off, though, this webinar is being recorded, and we will send all registrants of the webinar a link to be able to view the webinar after this series. I believe we have one more next week, and then we will send you a link, and you'll be able to reference it for your future benefit. Lastly, if you do have any questions throughout the presentation, we have left time at the end of the presentation for Danny to answer those questions. In the little GoToWebinar control panel, you can hit the question box, and in that question box, you can go ahead and type your questions that you have throughout the presentation, and we will answer those at the end. I will read those to Danny, and he'll answer those questions. So we recommend, we advise, if you do have any questions throughout the presentation that you think of, type those in there. We would love to answer those and help you gain clarification on exactly what enhancements we are making to our investment platform. But without further ado, what I'll do is introduce Mr. Danny Humphrey. Danny Humphrey is currently serving as the Vice President of HSA Wealth Services. He's been with Health Equity for a very long time, and he is what I call an expert in the investment platform, has been instrumental in this enhancement of our investment platform, is very well versed to be able to talk about the Health Equity platform and what we think is a really main competency of our service that we offer to all our employers. Without further ado, Danny, I'll turn the time over to you.
Thank you, everyone. Our apologies. We had some technical difficulties as I'm traveling, so I applaud Colton's skills in figuring it out. Today's webinar is around the investment platform of the HSA that Health Equity provides your employee population. And it should be understood that the changes that we are implementing, which will become effective March 31st, were really, the impetus behind it had to do with the new Department of Labor Fiduciary Rules. And so none of us like change. We understand that. Change can create confusion, but I must tell you that net-net, at the end of the day, this upcoming change is undoubtedly beneficial to your employees and to you as organizations providing high-deductible health plans with HSAs. And in the effort to enhance your employees utilizing this account as an accumulation account long-term, I believe that this DOL rule, in the end, hands down, is better. And we'll walk through the specifics of why throughout this presentation. I just want to update you on a couple things at Health Equity, sort of a summary around who we are. I know you're customers of ours, so it's not that you don't know us, but let me update you. 2.4 million HSAs we administer. That places us about number 2 or 3 in the industry. I say 2 or 3 because we're close enough with our second largest competitor, second, third-ish, that we probably swap those positions on a daily basis. We are a public company. Our ticker symbol is HQY. This will give you some wonderful visibility and transparency into our financial strength and solvency as an organization. We partner with health plans, 80 health plans nationally. The reason that's valuable is because our willingness to receive claims and eligibility data makes the HSA experience easier in the case where you have a health plan that is working with us and that is a health plan partner from whom we gather this information. $4.3 billion in assets under management. The reason that's important is because if you think about a health savings account as an account you contribute to and then can spend out of, the fact that at the end of the year there's still $4.3 billion left in these accounts is a testament to the savings element of an HSA and how it works. We are also adept at handling other health-based accounts such as HRAs and FSAs, not just HSAs. We have 33,000 employer groups that we serve and proudly call customers of ours, which range from a one-person operation all the way to some of the largest corporations in our country. We focus very, very highly on service. And at the end of the day, technology is great, and services are great, and self-service tools are great, but they have to be supported. And so we've hit 116 consecutive months of delivering on our service level agreements. Our customer satisfaction score, we call CSAT, runs at 91 out of 100. And here we are at the end of 2016, 97% of all HSA accounts ever opened with us are still with us. And we clearly recognize that employers may leave our service offering and move to another custodian in the HSA space, but we're finding that those employees who have accounts with us like to keep them with us, and it's something we're proud of and believe that it's a service element. So this slide here is my favorite slide in the deck, and the reason is simple. Because we're talking about investments today, and to me, the investments are the highest level of engagement that an HSA member has. And as you see on this slide, there are 3 levels of engagement. There's the spender, there's the informed consumer, there's the saver. You'll notice up the left side it says education and engagement, and up the right side it says contribution and balance. This, by the way, is an inverted trapezoid. I'm a math guy. And as it moves upward, there's a correlation between how much education and engagement a member receives and how much they put into the account and how more substantive their balances become. The spender, if we can focus on that for a moment, is really focused on 3 things. Is it easy to put money into this account? Is it easy to get money out of this account? And what are the tax benefits associated with those activities? And we all can agree that the lion's share of any employee population probably never leaves the spender experience. That tends to be their focus. That next level of engagement we call the informed consumer. High deductible health plans, of course, were established to try and provide incentivizations to the account holder to consume healthcare more conscientiously, so that any savings that could be procured from consuming healthcare conscientiously, they could keep. So in order to be an informed consumer, you have to have information, and that information needs to help you understand ways in which you can save money with your healthcare. This is actually one of the primary reasons we will partner with health plans to receive claims and eligibility data, because we've learned that you have to put that information, any helpful information in a medical spending decision needs to be put right at the tip of the noses of your employee, which is why at Health Equity we are willing to work with other vendors in your benefits engagement framework, such as dental and vision and medical and transparency and pharmacy benefits and telemedicine services. It's our belief at Health Equity, and frankly our empirical experience, that the more you can get information in the Health Equity portal to people who are spending those HSA dollars so that they can find ways to make better healthcare decisions with their spending, the more they can have the ability and be empowered to move to that highest level of engagement, which we call the saver. For the longest time in our industry, we define the saver as the person who has more money at the end of the year in the account. Really, let's put it this way, money left over at the end of the year versus spending it all. And that's a bad definition of saver. At Health Equity, we define the saver as someone who invests. Because one thing we've seen on our platform is that when someone begins to invest their HSA, a behavioral pivot occurs. And it's a pivot that's very tangible, and we'll share it with some data with you as we go through the slides. The catalyst, as I mentioned earlier, for the change in the investment lineup was a DOL rule that was passed recently. The rule was proposed in April of 2015, issued in April of 2016, and becomes applicable this coming April. Some of you, many of you, maybe all of you have heard recently that the new president and his staff have deployed an executive order to the Labor Secretary in an effort to really determine whether this fiduciary rule is in fact in the best interest of consumers and if there are any unforeseen, unintended consequences from it. I can tell you unequivocally that this fiduciary rule and its application in the HSA space is undoubtedly in the best interest of the end user. So please know that whether they delay this rule, even rescind this rule, it will not change what we plan to implement coming March 31st, because we visibly can see, and I'll illustrate it to you momentarily, that this is better. It's a better approach for the end user. And when you look at the bottoms in the second half of this, the bullets in the bottom half of this slide, you'll see that the rule focuses on best interest of the client, fees over commissions, reasonable compensation over arbitrary fees, fixed compensation over variable compensation. There's a sub-bullet there that says revenue share is difficult to align with the rule. I'll cover that in better detail in the next slide. And of course, transparency over hidden fees. Those of you who are familiar with the 401k space, this kind of rule, these kinds of requirements for best interest focus and transparency were deployed in the 90s. And it had a very material impact in the 401k space in that it reduced expenses to the participant, at the same time provided more visibility into all the costs and expenses related to having a 401k plan. Well, guess what? That's exactly what's happening in the HSA space, just essentially 15, 20 plus years later. So on the next slide, you'll see a table. And what I'm wanting to do is give you a little history lesson on the health equity investment platform, because this will give you, it's important in order to recognize the value of these changes we're making now, one has to understand where we came from. So that first column that you see titled Best in Class, that was a lineup we deployed in 2012. And that lineup was our primary lineup to all our employer groups. It had 41 mutual funds. It covered 11 different asset classes, meaning those are investment categories that you could essentially take those 41 and divvy them up to any one of those 11. When you invest in a mutual fund, it has its own operating expense ratio. And so if you took all those 41 funds, because clearly these mutual funds have to get paid for what they do, they charge a fund expense. That's an annualized figure. So if you added those 41 funds all together, then divided by 41, you would come up with an average of 1.08. That's 1.08% annually. You'll notice that I have an asterisk by that figure. Down at the bottom left is a disclosure. And the disclosure indicates that there's a 0.40 revenue share average paid to health equity. So we receive revenue share from these 41 funds, and it averages about 0.40 annualized. And health equity receives it because there is a cost and expense to providing an investment platform. Now, there's no additional, if you come to the next row where you see none, there's no additional fees we charge. And so that 1.08 essentially represented the totality of the expense to the HSA member investing in those 41 funds. Remember, I'm using averages. If you come down one more row, you'll see where it says total expense to member, range in parentheses. So when you were choosing amongst those 41 funds, the least expensive fund you would choose would have an annual expense of 0.92, and the most expensive of those 41 would have a 1.90, almost 2%, in other words, per year. And then that last row, we did not, have not, will not charge trading fees, loads, also known as sales charges, or short-term redemption fees. That's what that STR stands for. Now scroll to the right. In 2014, we added an additional lineup that someone could choose from to that 41, and it had 26 more funds covering the same 11 asset classes. I'm now coming down that column titled Investor Choice. If you took those 26 funds and ran the math, their average expense ratio is 0.63, but you'll notice there's no asterisk by that 0.63 because we were not receiving revenue share, meaning that 0.40 that you saw nested within the 1.08 of column 1, we were not receiving in column 2. That was purposeful. We were wanting to choose funds that didn't pay hidden fees, but it didn't mean that our fees went away. So we now, in that next row titled Admin Invest Fee, we inserted that 0.40 as a literal line item fee that you see it visually as an account holder who's investing. Remember, that figure only applies to the portion of an HSA that's invested. The range would be on the low end based on those 26 funds. You could choose a fund that was 0.02, and then if you add that to the 0.40 we charge, it's 0.42 total. So now that represents the totality of the expense, low end, all the way to 1.10. So just for a moment, look at that first column's total expense range, 0.92 to 1.90. Scroll to the right, 0.42 to 1.10, and what you see is fee reduction. And that was one of the goals that we had back in 2014. And just as an FYI, that was before this DOL rule appeared on the horizon, meaning we were already moving to a place where we wanted to be more transparent and not have hidden fee structures to our membership. So on this next slide, what you'll see here is I've added a third column to the far right titled Investor Choice, and I put 17 next to it just to represent 2017. That lineup has 23 mutual funds in it, and those first two lineups that you're looking at, that very first one, Best in Class with 41 funds, that's going away. That next lineup, the Investor Choice 26 funds, a subset of those 26 is part of that third column 23, and it's 12. So 12 of the 26 will continue and be kept. Those are the Vanguard funds, low-cost passive index, and they'll be included in these 23. And then we added something. So you'll notice we have 23 funds, 11 asset classes, just like you saw in the first two columns, but we added what's known as target date funds. Very, very common funds that are offered in 401k plans. And we believe their value in offering them in HSA plans is familiarity, because target date funds are a simple, sort of one selection method of allocating, diversifying, but choosing something that has a time horizon that you choose and you're familiar with. Now, the real issue here is that middle fund expense average row. So if you go from left to right all the way to the far right, you see 0.10. That's not a misprint. In essence, if you look from our original 41 fund lineup, we reduced the fund expense average by almost 90%. Significant reduction relative to any of the other two lineups we offered. Of course, we do not receive any revenue share out of those mutual funds, so we do still have our 0.40 charge that you see. And the two together become the totality of the expense to the account holder, which ranges on the low end from 0.42, on the high end from 0.57. What I really want you to recognize here is that since 2012, it's been a focus of ours to try and make sure we can reduce fees yet still provide breadth in terms of choice, asset class coverage, good fund quality based on performance analytics, risk analytics. And that's why if you scroll from left to right on that second to last row, total expense to member, you see continuous fee reduction, which, by the way, I contend in the next couple years we'll look at this table and the fees will continue to reduce. The more money that goes into health savings accounts, investing, begins to develop what's known as economies of scale, and those economies of scale is something health equity can leverage in order to bring down expense to the members. Couple things you need to know about this transition that'll occur March 31st. And I'm going to use the term legacy funds. The term legacy is meant to describe all funds that will be closed to new investments starting March 31st, which are the 41 funds and a portion of the 26 funds. So legacy funds will be closed to new investment March 31st. Investor Choice 2017 lineup, that's the 23 funds we just talked about, will be the only funds available for new investment after March 31st. However, if you have money in a fund that's closing, a legacy fund, those positions will remain until you as an account holder or until the account holder decides to liquidate them. So candidly, someone can keep them in perpetuity for as long as they like if they so choose. However, you should know that we will be communicating to the members about a mapping from the old legacy funds to the new Investor Choice 2017 lineup. Why would we do that? Well, we're totally fine with someone keeping their money in the old legacy funds, but it is a better decision for them to have those monies put into the new Investor Choice lineup funds from the expense structures I just showed you on the prior slide. So that those communications will be facilitated through the message center and through email to your employee population. There will continue to be no trading fees, no sales charges, also known as loads, no fund minimums. That means someone on our platform, if they wanted, could take $10 and put $1 into 10 different funds, and there's no short-term redemption fees. So in other words, the totality of the expense to the account holder is truly the 0.40 health equity charges for the investment platform plus whatever the fund expense average is of the fund they're choosing. A couple other notes. We, as you know, are the only HSA administrator that provides access to member-level investment advisory services. And it's done through a web tool called Health Equity Advisor. There's two service levels to the tool. Autopilot and GPS. That far right where it says self-driven, that's essentially for someone who just wants to manage their money on their own. I bring this tool up because if somebody is in autopilot, they don't need to do anything. April 1st, 2017, their portfolios will be automatically transitioned by the tool itself from old legacy funds to new investor choice funds, and it'll be mapped by asset class. So they don't have to do anything. Just stay a subscriber and the tool will go ahead and make the transition. If someone is subscribed to GPS, that's a service level where the tool makes recommendations to you as to what you ought to change, but you still control whether you want to change it or not. GPS subscribers will certainly get new advice telling them, here's new advice to rotate your funds out of legacy funds into the new funds, but the member must still go ahead and make the actual action. So they have to go into the tool and click implement advice for that transaction to occur. Lastly, if someone's just managing the money on their own, it's incumbent upon them. They'll have to be the ones to make the transition from old legacy funds to investor choice funds. But I want you to know that if they want to make it easy on themselves, they can sign up for this web tool, sign up for Autopilot, for instance, just for a day if you want, and then let the advisor tool go ahead and make the full implementation out of old legacy funds into the new investor choice funds, and then you can unsubscribe immediately afterwards, and it's essentially done for you. So I have to say, since we've announced these changes, I've gotten a lot of feedback from our employer clients with concerns, and obviously change is never fun, but I'm telling you this is a very, very positive change at the end of the day for the members. Now, having said that, I thought it'd be useful to give you some comparatives so that you can get a sense of the value of this change in a material way. So I have this table that has our 23 funds, the investor choice funds. This is the new fund lineup that will prevail starting March 31st. To the right, I have what I'm going to call sample custodian. So it's a competitor of ours, and their method of charging for investment, very standard from an industry perspective, so I thought that would be a valuable comparative. And then to the far right, you'll notice something titled self-directed. This is kind of an interesting nuance in the HSA space. In the 401k world, they would call this an open brokerage account or self-directed brokerage. In the HSA space, it's not quite as broadly developed, but there are some, a custodian, actually one custodian that we compete against, who does offer a self-directed offering where the employee who wants to invest can choose amongst thousands of mutual funds, not a limited subset like you see on the first two columns. So let's just run a little comparative here. You know, you look at our lineup that offers 11 asset classes plus target dates. The typical custodian in our space offers 8 asset classes. The self-directed option, NA stands for not accessible, because it could be 20, 30, 40 asset classes. The fund expense average, you can see on the health equity selection is 0.10. On the sample custodian example is 1.04 annualized. You see the double asterisk there. It's meant to disclose that they're receiving revenue share within that number. So nested within 1.04 is revenue share, and I ran the numbers, and it averages almost 0.40, just 1 basis point less. That next line that says admin investment fee, you already know we charge 0.40. It's actually charged monthly, by the way. So 0.40 charged monthly is actually 0.033. So members will see that. They'll see it on their statement. They can go online and see it. It's a very explicit line item expense. Competitors of ours will actually charge a flat fee. So $2 a month is a classic example. That's where that $24 comes from. It's annualized. And then, of course, self-directed tends to not charge any admin fee, which, by the way, on its surface tends to have a lot of appeal, at least visually to the eye. But as you'll learn in 2 more rows, there's a way in which a self-directed type HSA makes up the money. And the next row, total expense to member, you can see the range on our platform, 0.42 to 0.57. Scroll to the right. Now you see 0.44 on the low end, all the way to 2.08. But here's what you have to remember. You have to add that $24 fee in the row above into the math to determine the totality of the expense. I'm going to do that for you in the next slide. And lastly, in the self-directed space, I mean, the range could be as low as 0.05, which is very low, all the way to 2.25% annual. So very broad range. That last row, fees, in other words, trading fees, sales charges, short-term redemption fees, or fund minimums, we don't have any. Most of our competitors don't have any. But that self-directed option does. This is where they make up the money. This is how they make up for not charging a fee of any kind to invest, is they make it up on trades. They make it up with sales charges, short-term redemption fees, and they have fund minimums. So nothing is free in this world, as you all know, and it's a matter of trying to understand and ascertain where the fees come from. So let's take, for example, a comparative against our sample custodian. If you invested $2,000, by the way, I've got 2 tables here. The top table is rendered in dollars. The bottom table is rendered in what those dollars represent from a percentage standpoint. So that top table, if you invested $2,000 on the health equity platform in the new Investor Choice 2017 lineup, you would pay $10 a year. I'm going off averages, by the way. If that sample custodian scenario, it's $44.80 a year, of which 24 of the 44 is that $2 monthly fee. If you scroll to the right, investing, oh, by the way, I'm sorry, let's keep going down that column. The percentage represents 0.50 for health equity, right? So that $10 is 0.5%. That's what that percentage represents on the 2,000. Whereas the sample custodian, because of that $24 plus 1.04%, is at almost 2.25% annual. That's a very, very, very big difference. 5 times. Now go to the right. 10,000 invested. Again, health equity, it's going to be $50 a year for the investment piece. $128 by the sample custodian, of which 24 is that monthly flat fee. Just so you know, whenever a custodian in our space charges a flat fee to invest, it punishes small account balances. And the reality is in the HSA space, because this is a rather young account, is it's going to punish most account balances. It may not punish the account balances of executives or the highly compensated, but the lion's share of the employee population it does. So we do not believe in assessing flat fees. If you come down for percentage purposes, that $50 on 10,000 represents still 0.5%. You'll notice across the row there, the percentage never changes. That's the beauty of this, of charging it as a fee base based on the amount invested, because it equalizes everybody. Big accounts, small accounts are going to pay the same fee proportionally. Versus 1.28% on the sample custodian. Last column, investing $20,000. It's going to be $100 a year but from health equity. based on the averages from 23 funds, $232 a year from the competing custodian. Remember, 24 of the 232 is that flat fee. We stay at 0.5%, 0.50 per year versus 1.16. Sometimes I'll get a question, why does the sample custodian's percentages go down with the bigger balance? Because you have to remember that that $24 flat fee represents a smaller and smaller percentage of the amount being invested as the amount being invested grows. So, again, to reiterate, starting March 31st, we'll offer one lineup to rule them all. And it's this Investor Choice 2017. I've already walked you through these metrics that are in this table in prior slides. But we just wanted to have a slide to show you. These funds come from Vanguard, all 23 funds, including the target dates. It's how we were able to get the fund expense averages so low down to 0.10. Again, sometimes I'll get phone calls from those of you in the HR space who also straddle the 401k plan, and you might say to me, I still think your fees are high. I mean, it's wonderful that you got them this low. And my response to that is, look, in the HSA space, just like 401k, it's an issue of economies of scale. When a 401k plan has 500 million, 300 million, 100 million, and maybe even billions, they can leverage that to bring down the fee structures. The same applies here in HSA. When you as an organization start to accumulate substantive amounts of money in the HSA investment side of your employee population, we can certainly work with you to reduce these fee structures, but that's going to take time, but it will happen. A couple final slides. So I just want you to understand that we analyze the behavior of our members quite closely because we're in the business of really trying to help our members optimize the triple tax benefits of an HSA. And one of the things we see very clearly is the power of investing, and that's what this table speaks to. So look at that first row where it begins with 38%. Back in 2012, we tried to answer a simple question. Are we seeing contributory behavior between investing HSAs that's different from those who have enough to invest but choose not to invest, which for the purposes of this slide, I'm calling eligible non-investors? And what we found in 2012 was that the investing HSA contributes 38% more than their non-investing counterparts. Their balances are 171% larger. But that third item, the $6, is really what was fascinating to me. We wanted to analyze whether the spending behavior of investing HSAs is different than those who don't invest. And the answer is there isn't hardly any difference. Both groups swipe their cards, pay their medical. They don't modify or alter their behavioral use of the money, even if they invest. But the reason that's fascinating is because the real issue here as to how it is an HSA investing account, it becomes so substantively larger than a non-investing account is simple. They just simply put more money in. So in 2012, we deployed a variety of what we felt were behavioral nudges. We began to communicate more about investing when someone became eligible. We totally changed the investment options. We modified our web portal to have the look and feel of what people would be familiar with relative to a 401k sort of fund selection and allocation process. We deployed that advisor tool that I referenced earlier, the web tool. And look at what happened. By 2015, the investing population on our book of business at Health Equity contributes 81% more to their plan, to their HSA than their non-investing counterparts. By the way, that is across all ages and income levels, and it excludes money that is not their money being contributed. In other words, we exclude seed money from the employer, health and wellness, matching, or awards. We just focus exclusively on the money being contributed by the account holder. And yet, as you scroll to the right on the 2015 figures, balance is still substantially larger, and their spend difference really statistically negligible, meaning they only spend, the investing population, the spend difference between these two populations, the investing but eligible and eligible non-investing, is only $8 a year. A better way to say it is, when we looked at the averages, we were seeing that an average investor HSA might have spent $2,000 out of their account for 2015, and the average non-eligible non-investing account might have spent $2,008. So both groups are using the account as a medical spending account, but one group throws a lot more money at it, and it's the investing group. This comes from Fidelity. Fidelity did a study, and it's a study they do every year, to determine what the average couple will need in retirement during their lifetime to cover medical expenses not covered by Medicare. And this data is from 2015. It says they'll need $260,000, the average couple. Now, they conducted a survey as a follow-up, and the survey question was, now that you know you need to come up with $250,000 to cover medical expenses in retirement, how do you intend to do it? The number one answer was, I don't know. The number two answer was, I'll probably just use my retirement plan, my 401k or IRA. But that's a math problem, because for someone to get to $260,000 net after taxes, they'd have to withdraw $370,000, or of course $260,000 out of an HSA is tax-free. Now, let's all agree that the probability of employees in this country who have HSAs accumulating $250,000 for retirement is very, very small. But here's the important part of the equation. $60,000 in an HSA is better than zero. $6,000 is better than zero. So something is better than nothing. You know, the Wall Street Journal declared the HSA the most valuable, flexible, tax-advantaged account in America. But it's still interesting that we find many, many people don't know that they can even invest their HSA. So in our minds, the HSA and the 401k together become the optimal retirement planning solution for health and wealth planning long term. Some of the self-service tools we make available on our website to help you optimize. We have this HSA Optimizer, for example. It's a wonderful self-service tool on our website. We established a registered investment advisor. That's a wholly owned subsidiary of Health Equity that's focused exclusively on the investment experience. We believe this in great measure is why we've had such a high participation rate in investment at Health Equity. We also provide services where we can actually link a 401k plan to the HSA and show it in our own portal. And here's a perfect example of that. I'm going to close with this slide. I was asked the question, how long do I think it takes to educate and engage a population and move them from spenders to savers, an employee population? And my response at the time was a minimum of 5 years. Could be as long as 10 years. I mean, it takes time. This sort of education and engagement is something that has to be consistent. It has to be consumable and absorbable. It has to be given in cluster datas, which means you take group by demographic and communicate. A 45-year-old woman might need a different message than a 25-year-old woman, and the same, for men. I mean, the messaging needs to be specific and relevant. But here's the point of this slide. When we analyze 5-year-old HSAs that are 5 years or older on our platform, the accounts that exclusively are transactional only, meaning they don't care about investing, they truly just focus on using this as a spending account, the average balances for that group is $3,685. However, if an account at Health Equity is 5 years or older and has invested at least 1 penny or more during that 5-year period, we find the average balance to be $19,661. If you break down that balance by what they're invested in, $5,400 is in cash, $14,000 is an investment. This is the power of investing. It's why it is my contention that this will become, alongside the 401k, the sidecar health plan, long-term retirement planning solution. So with that in mind, I'm done with my presentation. Colton, any questions filtered in that I could answer?
I don't see any questions as of yet. Once again, we would encourage you that if you do have questions, to put those in that question box. Danny will go ahead and go through some questions that he gets on a fairly consistent basis while we wait, and then I'll let you know if any questions come through, Danny.
Yes, I mentioned this earlier, but it warrants mentioning again. We've been asked many times, what happens if this DOL rule gets rescinded by this current administration? And the answer is, we don't care if they rescind it. We're going to go forward as is. many organizations in the financial services space, not necessarily an HSA, have determined what we've determined. This is in the best interest of end users, period. And whether it's legislated or not, and no matter how we were brought to this place, it makes sense to keep it in place. I often get asked if we intend to change the fund lineups going forward in the future. And the answer to that is, look, we're always trying to enhance the platform. I don't see a major revision coming in the future. I will say this, I'm highly confident that we won't get rid of these Vanguard funds that we're offering. They're low cost, they're institutional share classes and institutional plus, which typically are share classes only offered at retirement plans with billions of dollars. So we managed to procure those funds in an effort to reduce fund expense.
Perfect. Well, we haven't had anything come through, so I want to thank everyone for their attendance today, especially thank Mr. Danny Humphrey for his presentation. And if you do have any questions that come up, feel free to contact your health equity representative, and they're more than happy to get you in contact with the right person. We appreciate your time, and we look forward to working with you in the future. Thank you.
Thanks, everyone. Be well.